Welcome to Course 2, Unit 2, Lesson 2, What is the S&P Rating? In this lesson, we're going to learn what is a credit rating, and we're also going to learn what does a rating tell me about risk. So let's get started. So this is a pretty short lesson, and all I'm doing is highlighting different credit ratings and how they impact you as an investor. So when we look at this chart, we have the three different major credit rating companies, which is Moody's, the S&P, and also Fitch. And they basically have the exact same rating scheme here. You'll see as you go to Moody's, they have a big A with two lowercase a's, where S&P uses three capital A's. But it's all the same thing. It's all the same scale. And as you look at this scale, over on the right-hand side, if you focus over there on the right-hand side, you can see that at the very top we have a prime investment, meaning it doesn't get any better. This is a company that is absolutely going to be able to repay their debts. And then at the very bottom, as you look down at the bottom, the lowest is in default. Okay, and that's what you really want to stay away from, because that's a company that's going under and they're going to go bankrupt, or even a municipal government or a state government that's going to go bankrupt. And so they're not going to be able to repay their loans. So if you're buying a bond, and let's say you bought a AAA bond, the chances of that company or government repaying you all your coupons and then giving you your par value back at the end of the investment is very good with a prime investment. For one that's rated in default, it's very bad. It's not likely. And then everything in between is something that you would have to figure out. And so as you go down the scale, the two main categories here as you look at this chart is that there's investment grade and then there's non-investment grade. And so everything that's above the triple B minus, or the B lowercase a 3 for Moody's, everything above that is considered investment grade. Anything below that is non-investment and understood as being speculative. So that's pretty important to understand. So this can work for bonds, or this can work for stocks. If you say you're considering buying a stock and you're kind of concerned because maybe the company has a little bit more debt than what you'd like, what you could do is you could go into the corporate page, you could look up the information on the company, and you could look at the debts that they have and look at their bonds. And when you look at their bonds, you could see what the category is for those bonds that the company has out. So if you're looking at a company and they have a bunch of AAA bonds, that's probably a company that's in no circumstances going to be in trouble to repay those debts, which is a good thing. That's what you're looking for, especially when you're buying stocks. You want to buy a stock that has very minimal debt, and if they do have debt, it needs to have a very high credit rating. Now, when you're buying bonds, you can maybe flirt with coming a little bit lower, but that's all based on the amount of risk that you're willing to assume. So the thing that I get frustrated with whenever I look at charts like this is, what does a AA bond mean to you? How much risk is that? And there's no way a person can actually answer that question without knowing numbers that are associated with that rating. And so I kind of laugh when I see these charts, because they really don't tell anybody anything, because there's no statistics behind it. So I'm going to throw some statistics behind it to kind of show you what some of those ratings equal. Now, unfortunately, I just have Moody's and the S&P numbers here, but it's pretty neat to kind of look at this chart and you can see the comparison. So that number up there is how many of them actually defaulted based off a percent. So as we look at the very top, the AAA rating for Moody's, if you were a municipal government, both Moody's and the S&P, if you had that rating, there was a 0% chance of you actually going into default. But if you were a corporation, you can see for Moody's it was 0.52%, and for the S&P it was 0.6%. So that's how much risk, you can put a number on it, how much risk was associated with that rating for both of those organizations. So let's go down. And if you remember, I said the BA or the BB is whenever things start becoming speculative and non-investment grade. And if you look at those numbers, you can see a drastic change in the numbers. Now, something I find kind of interesting is let's look at the corporation number for the BB for Moody's. That went to 19% of those companies went into default. 20%, that's really high in my opinion. When you look at the S&P, they actually had almost 30%. So S&P, you can see, has a much more liberal rating compared to Moody's that's much more conservative and consistent. So as we look, when we go even lower, you can see how much higher those numbers go. So when you look into the C category, especially for corporations, 70% for both Moody's and the S&P, that's extremely high. So if you're buying bonds that are down there, there's only about a 30% chance you're going to get your money back, which is really, really low. So it's nice to know numbers behind these letters, which mean absolutely nothing to anybody for a person who's not intimately involved with buying and selling bonds. So when you look down there at the numbers for the averages, if you're buying investment grade bonds for corporations with a Moody's rating, there's only a 2% chance that it's going to fail. For the S&P, it's double that. It's 4%, which is very significant when you look at how they're rating these things. Now, for non-investment grade, the numbers go much higher, especially for corporations. You're at the 31 to 42% range. So something that is really interesting, people will look at a AAA rating for a corporation, but that's almost the same as being down there in a BBB for a municipal. And that's something that people really don't understand or have any idea about. So if you're comfortable buying a AAA corporate bond, you should be equally comfortable buying a BBB municipal bond because the numbers are actually better than the AAA corporate. So that's something to really think about whenever you're buying bonds, and think about this chart and how secure those municipal bonds are as you go into a lower category and rating. So what's important? Here's something that I will strongly suggest, and this is a quote from Warren Buffett, is a public opinion poll is no substitute for thought. So just because a lot of people are scared to go out and buy that BBB municipal bond doesn't mean you should be. I mean, you can back up your thoughts with calculations, with statistics, and you can put some numbers to what's going on. Don't just buy into what somebody said, oh, you should only buy AAA bonds. You can look at this and determine things for yourself. Looking at the letters is pointless. You need to understand the statistics behind the letters. So that's something that I encourage you to go out there and seek and do some more research on as you become more interested in investing in bonds. In the end, you need to measure your own tolerance for risk and be realistic in what you actually know. And that's some of the best advice I can give you for investing in bonds and also for investing in stocks. So this concludes Course 2, Unit 2, Lesson 2, what is the S&P rating? In this lesson, we learned about what the credit rating was, and we learned what does the rating tell us about risk. And so I'll see you in the next lesson.